All right, let's cut right to it. In the next 5 minutes, we're going to give you the complete playbook for finance and investing. We'll slice through all the noise and give you a concrete action plan you can literally start using today.
So, here's what we're going to cover. We're kicking things off with the single most powerful force in all of finance. Then we'll get practical, budgeting, building a portfolio, and using the right tools. We'll also stare down some common market fears and then wrap it all up with a clear step-by-step plan. Let's dive in.
First up, and honestly the most important thing you need to grasp, is the power of compounding. This isn't just some boring financial term, it is the engine that will build your wealth. Einstein supposedly called this the eighth wonder of the world, and it's because of a really simple idea. Your money makes money, and then that money starts making its own money. It creates this incredible snowball effect, an exponential growth curve that feels like magic over time. To really see what this looks like in action, check out this number. Imagine you invest just $10,000 when you're 22. If it earns a 15% annual return, by the time you're 65, that one-time investment could explode to over $4 million. That's what happens when you give your money a long, long runway to grow. But, and this is the really crucial part, if you wait just 10 years, start at 32 instead of 22, that final number gets slashed by more than half. This just goes to show you that your most valuable asset isn't the money you invest, it's the time you give that money to work for you. And that brings us to the biggest mistake people make, trying to time the market. Jumping in and out, trying to catch the highs and dodge the lows. But look at the data. If you missed just the 10 times best trading days over a decade, you could have cut your total returns almost in half. The lesson is so simple. It's all about time in the market, not timing the market. Okay, so now that we get the why, let's talk about the how. A powerful investment strategy needs fuel, right? And that fuel comes from having a simple, effective budget. The 50-30-20 rule is a fantastic, no-nonsense way to do this. It just splits your after-tax income into 3 simple buckets. It makes it super easy to see where your money's going, and, most importantly, make sure you're putting your future first. So here's the breakdown. 50% of your take-home pay goes to your absolute needs, rent, groceries, that kind of stuff. 30% is for your wants, all the fun things that make life worth living. And that last absolutely crucial 20%, that's for your financial goals. This is the money that's going to fuel that compounding engine we were just talking about. All right, with our budget sorted, we've got the cash to invest. So let's talk about actually building your portfolio. And believe it or not, the single most important decision you're going to make is how you mix your assets together. It's a concept called asset allocation. And all the research shows that this one decision, how you split your money up, has a way bigger impact on your long-term returns than trying to find the next big winning stock. The 3 main players are stocks, bonds, and cash. Think of stocks as the high flyers. They have the biggest potential for growth, but also the most risk. Bonds are the steady hand, offering more stability and income, but with lower returns. And cash, well, cash is your safety net, but it can lose its power over time because of inflation. The right mix for you totally depends on your goals and your timeline. Okay, let's talk about tools. It's not just what you invest in, it's how you do it. Using the right investment vehicles and staying disciplined can make a world of difference. So 2 of the most popular ways to invest are exchange-traded funds, ETFs, and mutual funds. They both give you instant diversification, which is great. The main difference? ETFs trade like stocks all day long, so they're super flexible. Mutual funds, on the other hand, are only priced once at the end of the day. Now, you have to hear this because this is where ETFs really shine. Tax efficiency. Because of their unique structure, they have a way of avoiding taxable events inside the fund. And the result? It's honestly stunning. In 2024, only about 5% of ETFs passed on taxable capital gains to investors. Compare that to a massive 43% of mutual funds. Over time, those tax savings can be a huge boost to your returns. So, once you've set your mix of assets, you can't just forget about it. Your portfolio can start to drift. Your best investments grow and become a bigger piece of the pie, which can secretly be adding more risk than you want. That's where rebalancing comes in. It's just the simple discipline of selling a little of your winners to buy more of the others, bringing everything back to your original target. Investing isn't just about the numbers. It's about psychology. So let's tackle the common fears that cause so many investors to make costly mistakes.
Ah, the classic question. Here's the deal. Since markets generally trend up, history shows that investing a lump sum right away actually wins about 2/3 of the time. But if you're nervous, and that's totally normal, there's a great strategy called dollar cost averaging. You just invest a fixed amount of money regularly. It's a fantastic psychological trick to get you in the market and keep you there. If one market feels pricey, the answer is always diversification. For instance, US stocks recently were at a pretty big valuation premium compared to international ones. Spreading your bets geographically is so important. It helps you manage risk and lets you capture growth wherever it's happening in the world. Yeah, inflation is like a silent thief. It eats away at your wealth. And while it can really hurt things like bonds, assets like stocks have been a great long-term shield because good companies can just raise their prices. But you know what's guaranteed to lose? Holding too much cash. That's a surefire way to lose purchasing power over time. Okay, we have covered a ton of ground, so let's boil it all down into a clear, step-by-step action plan that you can start using the second this is over. Think of this as the financial order of operations. Step 1, build your safety net, a 3 to 6 month emergency fund. Step 2, kill high-interest debt, like credit cards. The interest rates are brutal. Step 3, max out your tax-advantaged accounts, like a Roth IRA where your money can grow and come out completely tax-free. Only after you've done all that should you start pouring money into a regular taxable account. And as we look ahead, the big theme a lot of pros are talking about is global diversification. Relying too heavily on just one country's market is a risky game. A broader, global portfolio can lead to much more stable returns in the long run. So let's end right where we started. That power of compounding is very, very real, but it doesn't wait for anyone. The single best thing you can do for your financial future is to start today. Set up automatic contributions, take your emotions out of the driver's seat, and just let time do the heavy lifting for you. The question isn't if you'll start, but what small step will you take today to completely change your tomorrow?